Welcome to today's explainer. Let's jump right in. Picture this. You just inherited $100,000 today. You decide to lock it away in the stock market for the next 30 years. You know, the ultimate set it and forget it strategy. But, as any seasoned investor will tell you, what you invest in matters just as much as how long you wait.
Now, let's say a friend of yours gets the exact same amount, 100 grand, and invests it on the exact same day. Fast forward 30 years, the dust settles, the market is done what the market naturally does, but wow, the results are shockingly different.
One portfolio, it's ballooned to well over $1 million. The other is worth significantly less. And remember, both were heavily exposed to the exact same market over the exact same 3 decades. That massive divergence really comes down to the absolute biggest dividing line in modern finance: index funds versus active management.
Okay, let's dive into this. Here is our roadmap for today. First, a tale of 2 portfolios. Second, index versus active funds. Third, the hidden cost of fees. Fourth, the Warren Buffett bet. And finally, choosing the right strategy.
Starting off with Section 1, a tale of 2 portfolios.
So, meet Emma and Michael. They're both 25 years old, and they both religiously commit $500 every single month. Their savings discipline is literally identical, but their vehicles differ. Emma leverages an index fund, while Michael relies on an active fund. Over 30 years, who do you think actually wins?
Well, the traditional logic, which by the way is heavily marketed by Wall Street, is that the professional fund manager absolutely must win. I mean, they have entire teams of analysts, complex algorithmic models, direct access to company executives. The assumption is that this informational edge guarantees a better result. But as the hard data shows, financial physics just doesn't always work that way.
Moving right along to Section 2, index versus active funds.
Let's look at Emma's path. Her index fund is structurally passive. It's basically just designed to mirror a broad market benchmark, like the S&P 500, usually by weighting companies by their size. It doesn't waste capital trying to hunt down individual winners. It simply captures the aggregate growth, the dividends, and that historical upward drift of the entire market ecosystem over time.
Think of it like this. Instead of agonizing over betting on one specific horse to win, an index fund is the equivalent of just owning the entire racetrack. You really don't care which specific stock crosses the finish line first, because as long as the broader economy continues to function and grow, your portfolio wins. It's a beautiful thing.
On the flip side, Michael's active fund operates on human conviction. Managers are constantly trading stocks in this relentless attempt to beat the benchmark. But here is the major structural headwind they face. All that frantic buying and selling generates massive trading friction, tax inefficiencies, and cash drag. To actually beat the market, an active manager doesn't just have to be right. They have to be right by a wide enough margin to cover all of their operational costs.
Which perfectly segues into Section 3, the hidden cost of fees.
Now, what's really interesting here is the mechanics of the expense ratio. Let's assume both funds capture the exact same gross market return. Investor A's passive index charges a razor-thin 0.05% expense ratio. Investor B's active fund, it charges an industry-standard 1.00%. Now, on paper, a single percentage point sounds like, I don't know, a rounding error, like it shouldn't really matter. But over a 30-year investing horizon, that 1% fee is literally a financial parasite. Because fees compound exactly like interest does, just in reverse. A 1% annual fee doesn't just eat 1% of your final wealth. Over 3 decades, it can consume nearly a third of your total potential returns. Think about that. You are taking 100% of the risk, but the fund manager gets 30% of your lifetime profit. Let's look at a real-world example in Section 4, the Warren Buffett bet.
So back in 2007, Warren Buffett wagered a cool $1 million that a standard S&P 500 index fund would beat a basket of elite hedge funds over 10 years net of fees. By year 5, the index fund had established a very steady lead, and by year 10, the index fund absolutely crushed the active managers. It wasn't necessarily that the hedge funds picked bad stocks, but their layered fee structures, which are often 2% of assets and 20% of profits, just made it mathematically impossible to keep up over a long horizon.
And you know, beyond just the raw math, there is a massive behavioral advantage to consider. Active investing breeds decision fatigue. Imagine every single quarter you're agonizing over your manager's performance, constantly wondering if it's time to pivot or sell. Indexing completely eliminates this behavioral trap. By just accepting the market average, you insulate yourself from that emotional urge to panic sell or chase past performance. You survive the volatility because the strategy requires absolutely zero intervention.
Finally,
Let's wrap things up with Section 5, choosing the right strategy.
The reality of portfolio construction is that it actually doesn't have to be a binary choice. Lots of sophisticated investors deploy what's called a core and satellite strategy. They allocate, say, 80% of their capital to ultra-low-cost index funds, securing that broad market return for the bulk of their wealth. Then, that remaining 20% acts as a satellite, deployed into high-conviction active funds to hunt for targeted outperformance. It's a really pragmatic way to anchor your portfolio while still taking some calculated, specialized risks.
At the end of the day, building true generational wealth rarely relies on magically picking the perfect fund. It relies on executing 4 unglamorous truths. Start early, invest consistently, ruthlessly optimize your fees, and stay invested through the chaos. Time in the market is always going to be the ultimate driver of compounding wealth.
So we come right back to that $100,000 question. Now that you understand the relentless drag of compounding fees, the statistical headwinds facing active managers, and the quiet, historical power of simply owning the entire market, which path will you choose to build your financial future?